Welcome to the first of a series of videos on business combinations. This topic is discussed in advanced accounting classes, and it's also useful for understanding mergers and acquisitions in capital markets. This first video will be a lecture explaining business combinations along with some examples, and we will do subsequent videos working through some problems. Hopefully this video will be useful for accounting students who are currently taking advanced accounting. So first thing to note right off the bat is that business combinations are different from non-strategic investments and significant influence in investments, and those are typically discussed in intermediate accounting classes. So a business combination is defined in IFRS 3 business combinations as a transaction or other event in which an acquirer obtains control of one or more businesses. So this definition has two key aspects: control and businesses. When a business combination does occur, we apply IFRS 3. But on the other hand, if an entity acquires all of the assets of another entity, but they do not meet the definition of a business, then IFRS 3 would not be applicable. So buying a group of assets that do not constitute a business is a basket purchase, but it's not a business combination. So a business consists of inputs and processes applied to those inputs that have the ability to create outputs. So for example, raw materials into a manufacturing company or IP for a tech company. Control can be achieved by the purchase of net assets or by the purchase of enough voting shares to gain control over the use of the net assets. So in the latter situation, a parent-subsidiary relationship is created, and that requires the preparation of consolidated financial statements, which we will speak about in a future video. So as you can see here on the screen, the guidance for determining control is provided in IFRS 10 Consolidated Financial Statements. Appendix A of IFRS 10 states that an investor controls an investee when the following three elements are present. The investor has power over the investee, the investor has exposure or rights to variable returns from its involvement in the investee, and the investor has the ability to use its power over the investee to affect the amount of the investor's returns. So as you can see here, the definition contains three important elements: power, returns, and the links between power and returns. Control can be present with less than 50% of voting shares if other factors indicate control. So for example, an irrevocable agreement with other shareholders to convey voting rights to the parent. If the parent holds rights, warrants, convertible debt, or convertible preferred shares that would, if exercised or converted, give it greater than 50% of the votes, or if there are contractual agreements which give control. So this was a general description of control, but if you'd like me to make a video elaborating on control elements, please leave a comment in the description box. So there's many types of business combinations as listed here on the screen, and some of them, more common terms that you've heard of include mergers, takeovers, and acquisitions. Some of the reasons for business combinations are to defend against a competitive position within a market segment or with a particular customer, to diversify into new markets or geographic regions, or to improve the company's rate of innovation by acquiring new technology or intellectual property, such as, this is very common in the biotech industry, and some of these other ones that you can review as well. So business combinations can be described as either friendly or hostile. So sometimes the management teams of the target company or the acquiree will employ defenses to resist a takeover because they don't want to be taken over. And these defenses can include: one is the poison pill. So this occurs when a company issues rights to its existing shareholders, exercisable only in the event of a potential takeover. So you purchase additional shares at prices below market. And a recent example is that the management of Twitter used this when Elon Musk stated his intention to submit a formal tender offer for Twitter. Another one is the Pac-Man defense. So this involves the target company making an unfriendly countervailing takeover offer to the shareholders of the company attempting to acquire it. So in essence, the Pac-Man defense responds to a hostile takeover attempt with a hostile takeover attempt. A white knight is another defense, and this is where the target company searches out another company that will come to its rescue, a white knight, with a more appealing offer for its shares. And finally, selling the crown jewels. And this involves selling certain desirable assets to other companies so that the would-be acquirer loses interest. Essentially, there are three main forms of business combinations. One company can obtain control over the net assets of another company by purchasing its net assets, purchasing the shares of the company, or control through a contractual agreement. So when it comes to purchasing of assets or net assets, the transaction is carried out with the selling company. The shareholders of the selling company have to approve the sale, as well as decide whether the company should be wound up, or meaning sold, or continue operations after the sale. With regards to purchase of shares, it's an alternative to the purchase of assets for the acquirer to purchase enough voting shares from the shareholders of the acquiree, that is the company that's being bought, that it can determine the acquiree's strategic operating and financing policies. And this is actually the most common form of business combination, and it is often achieved through a tender offer made by the management of the acquirer. And interesting to note is that when purchasing shares, the transaction is usually consummated with the shareholders of the selling company. And finally, control through contractual arrangement. So control can be obtained through a contractual arrangement that does not involve buying assets or shares. And because of this, the acquired company or the acquiree makes no journal entries when the acquiring company purchases shares. IFRS 3 outlines the accounting requirements for business combinations, and the main principles are listed here on this slide. And all business combinations should be accounted for by applying the acquisition method, and we're going to be doing an example. An acquirer should be identified for all business combinations. The acquisition date is the date the acquirer obtains control of the acquiree. The acquirer should attempt to measure the fair value of the acquiree as a whole as of the acquisition date. The acquirer should recognize and measure the identifiable assets acquired and the liabilities assumed at fair value and report them separately from goodwill. And the acquirer should recognize goodwill if there is any. The acquisition cost measured at the fair value of consideration given to acquire the business and is made up of the following: any cash paid, the fair value of assets transferred by the acquirer, the present value of any promises by the acquirer to pay cash in the future, the fair value of any shares issued. The value of shares is based on the market price of the shares on the acquisition date, and the fair value of contingent consideration. And just make a note that the acquisition cost does not include costs such as professional fees or costs of issuing shares. And one of the reasons is because these costs do not increase the fair value of the acquired company. These costs should be expensed in the period of the acquisition, and costs incurred in issuing debt or shares are also not considered part of the acquisition costs and should be deducted from the amount recorded for the proceeds received for the debt or the share issue. The acquirer should recognize and measure the identifiable assets and liabilities assumed at fair value and report them separately from goodwill. The identifiable assets include those with values not presently recorded by the acquiree, such as internally developed patents, which is an intangible asset. Remember, intangible assets are only listed on a company's balance sheet if they are acquired assets, and assets with an identifiable value and useful lifespan can thus be amortized. And finally, we can only allocate to items that meet the definition of assets and liabilities under the IASB's framework. Goodwill is the excess of the purchase price over the fair value of identifiable assets and liabilities. If the acquisition cost is less than the fair value of the identifiable net assets acquired, we have what is sometimes described as a negative goodwill situation. And this is also known as a bargain purchase, which could result in the reporting of a gain on the purchase by the acquiring company. In the next video, we will do some examples of control through purchase of net assets.